Introduction. There's something very interesting about income investing that I've realized after years of watching the US market. Sometimes the worst looking news isn't actually the worst news, and sometimes a decision that disappoints investors today can actually be the decision that makes an investment more sustainable for years to come. Big has just gone through one of those moments. If you own BIGE, you've probably seen the announcement that disappointed quite a few investors. The fund's distribution has been reduced significantly. Previously, Big paid about 31.25 cents per distribution, twice a month. Now that figure has been reduced to roughly 20 cents per distribution. And honestly, I understand why many investors are frustrated. Because when we buy a high-income investment, the first thing we usually look at is very simple. How much money am I getting every month? When that number goes down, our natural reaction is to assume that the investment is getting worse. But if you've been investing long enough, you understand that financial markets aren't that simple. An investment shouldn't be judged only by how much money it pays you today. You also have to ask, where is that money coming from? Is the underlying portfolio strong enough? Can the NAV be sustained? And most importantly, can this strategy survive for the next 5 or 10 years? Those are the questions that really matter. Imagine someone owns a business. The business generates $100,000 in profit every year, but the owner decides to withdraw $120,000 to spend because he wants to maintain a very high level of income. For a while, everything looks great. He has plenty of money to spend. But if that continues for long enough, you already know what's going to happen. The business will start eating into its capital. Eventually, the question is no longer how much money the business pays its owner each year. The real question becomes, does the business still exist? Income investing works on a similar principle. And that's exactly why I think we should look at Big from a different perspective. Don't just focus on the fact that Big recently reduced its distribution. Instead, look at what Big is becoming as a result of this change. Because Big today is not exactly the same Bigs that launched originally. And this is something I think many investors may overlook. When Big first launched, it held only around 10 stocks. The portfolio was heavily concentrated in high-growth, high-volatility names, with strategy and Coinbase playing significant roles. And the timing of the launch wasn't exactly ideal. When Bitcoin declined sharply, Coinbase came under pressure. Strategy also came under pressure. And when major holdings in a concentrated portfolio fall at the same time, the fund's NAV is naturally pulled lower. That creates a very uncomfortable cycle for a high-income product. NAV declines. The ability to generate income is affected, but investors still expect an extremely high distribution. Eventually, the fund has to make a choice. Evolve chose to make a change. Big expanded its portfolio from roughly 10 stocks to 23. The new holdings aren't limited to technology or crypto. They also include larger and relatively more stable companies such as Berkshire Hathaway, Visa, Johnson & Johnson, Walmart, ExxonMobil, JP Morgan, and many others. And to me, this is the part of the story that deserves the most attention. Because when a fund changes its portfolio, lowers its distribution, and adjusts the way it uses covered calls, the question shouldn't simply be, why am I getting less money? The better question is, do I now own a better investment for the next 5 or 10 years? That's the difference between an investor who only focuses on income today and an investor who truly cares about long-term total return. And in the next section, we're going to take a much closer look at exactly what has changed. Because if you look at BIG only through the lens of its new distribution, you might think this is a step backward. But if you look at the new portfolio, the covered call strategy, the potential protection of NAV, and how Evolve is positioning BIGE for the long term, the story could be completely different. The main body. Now let's put that 20-cent distribution aside for a moment. I want us to look at Big from a broader perspective, because if we focus only on the distribution, it's very easy to miss the most important thing happening inside the fund. The most important question isn't how much BIG has reduced its payout to investors. It's how BIG has changed to potentially become more sustainable in the future. Think back to BIG in its early days. A portfolio with only around 10 stocks may sound attractive. It's simple. It's easy to understand. And if those stocks perform extremely well, the returns can be impressive. But concentration always has two sides. When you're right, it can help you make money faster. But when you're wrong, it can also make you lose money faster. That's exactly what happened when BIGY had significant exposure to strategy in Coinbase. Coinbase, in particular, has business results and stock performance that are closely tied to sentiment in the crypto market. Strategy also has a very high level of sensitivity to Bitcoin. So when Bitcoin entered a correction, BIGE wasn't simply a portfolio of US stocks. It had effectively become a portfolio with significant exposure to a highly volatile asset class. And this is a very important lesson for any investor. A portfolio can own great companies and still be risky if the allocation structure isn't appropriate. You can own some of the best businesses in the world, but if 40% or 50% of your portfolio depends on one industry or one economic factor, you're still making a very large bet on a single story. That's why I view BIG's expansion to around 23 stocks as a meaningful development. Now we're not just seeing high-growth names, we're also seeing Berkshire Hathaway, Visa, JP Morgan, Johnson & Johnson, Walmart, ExxonMobil. These companies don't have the same characteristics as Coinbase or Strategy. They operate in different industries, generate cash flow in different ways, and respond differently to changes in the economy. A bank may benefit from a very different economic environment than a technology company. A consumer company like Walmart may respond differently than a semiconductor company. And an energy company like ExxonMobil is influenced by an entirely different set of factors. That is the power of diversification. Diversification doesn't guarantee that you'll never lose money. No portfolio can do that. But it can help prevent a single mistake from becoming a disaster for the entire portfolio. And I think this is one of the most important changes happening with BIGY. It's becoming more normal. That may sound strange, but in long-term investing, normal can actually be a very big compliment. A portfolio doesn't need to excite you every single day. It needs to help you sleep better at night. Because the ultimate goal of an income investor isn't to have the fastest growing account over a single month. The goal is to build an asset that can continue generating cash flow for many years. And that brings us to covered calls. If you're not familiar with this strategy, think about it in simple terms. You own shares of stock. Then you sell call options against a portion of those shares. In exchange, you receive an option premium. That premium becomes a source of income for the fund. But there's a trade-off. If the stock rises above the option's strike price, the fund may have to give up some of the potential upside. That's the exchange. You receive income today in return for giving up some potential upside tomorrow. BIG is using covered calls on roughly 50% of the portfolio. This isn't an extremely passive strategy. It's relatively active. But I don't think that automatically makes it a bad strategy. In fact, for an investor looking for income, covered calls can be very useful when they're used properly. What's even more interesting is that Evolve appears to have more flexibility in how it implements the strategy. Instead of always selling at the money calls, the fund can potentially use calls that are slightly out of the money. That may sound like a small change, but economically it can be meaningful. When the strike price is a little farther away, the fund can potentially retain more upside if the stock continues to rise. In other words, BIGE is trying to find a balance between two goals that often work against each other: income and growth. And that is one of the biggest challenges facing almost every high-yield ETF. If you want extremely high income, you usually have to accept some limitations on growth. If you want to maximize growth, you may have to accept lower income. There's no free lunch in the financial markets. The important thing is finding the balance that fits your own investment goals. And that's also why I don't think we should look at a yield of around 30% on BIGA and immediately conclude that this is a 30% annual return investment. Those are two completely different concepts. Distribution does not equal total return. If a fund pays you 30% but its NAV falls significantly, you can't simply say that you earn 30%. On the other hand, a fund with a lower distribution but steadily rising NAV and strong total returns could produce a much better financial outcome over the long term. That's why I always encourage income investors to look at three things: the cash flow you receive, the health of the NAV, and total return. That's the complete picture. And when we look at BIGE that way, we start to see something pretty interesting. If we look at its performance since inception, BIG clearly hasn't looked great. There's no reason to avoid that fact. The original portfolio struggled, the timing of the launch wasn't favorable, and the concentration in several highly volatile stocks made the results even more challenging. But investing isn't a photograph, it's a movie. A photograph tells you where big has been. The movie tells you where big may be going. And more recently, after the portfolio changes, big has started showing some more noteworthy signals. According to the data presented in the video, when looking at approximately 1-month total returns, BIGY has outperformed several major benchmark ETFs. I'm not saying 1 month is enough to prove that BIGE has succeeded. It isn't. 1 month is far too short. But it does give us a signal worth watching. Perhaps the changes to the portfolio are beginning to have an impact. And if we look back at the history of HYLD, we can see a similar lesson. HYLD went through a very difficult early period. Many people concluded at the time that the product simply wasn't good. But after changes to its strategy and portfolio, HYLD gradually became a very different product. And that teaches us a simple lesson. Don't judge a strategy solely by its first version. A company can change. An ETF can change. A strategy can be adjusted, and BIGE is doing the same thing. Of course, that doesn't mean we should ignore the risks. A high yield still comes with higher risk. Covered calls can still limit upside. Leverage can still increase volatility. And no one can guarantee that BGE will deliver what investors expect. But if Evolve can maintain a more diversified portfolio, generate a sufficiently high level of income, protect NAV, and still allow for some capital appreciation, BIGE could become a much more balanced product than it was in its early days. And that's exactly why I believe the most important question isn't, does BIG still pay as much as it used to? The better question is BIG today more sustainable than the BIG of yesterday? Because in long-term investing, sometimes making less money today is exactly how you position yourself to have more money in the future. And perhaps this is the right time to take a step back and stop looking at BIG as just a number on a screen. Instead, let's look at it as an investment lesson. Because the story of BIG is actually bigger than BIG itself. It speaks to a mistake that many income investors make. We tend to be attracted to the biggest number. An ETF paying 5% sounds good. An ETF paying 10% sounds even better. And when we see a product with a distribution of around 30%, our natural reaction is, why wouldn't I put all my money into this? But the financial markets don't work that way. A high yield doesn't automatically make an investment a good investment. What matters is understanding where that income comes from, how much risk comes with it, whether the distribution can be sustained, and what happens to your capital over many years. If you're receiving 30% in income today, but your NAV keeps declining, you need to ask some serious questions. But if a fund can generate a high level of income while maintaining or growing its NAV over the long term, then the story is completely different. That's why I think BG's distribution cut needs to be viewed from a much longer-term perspective. Yes, we are giving up some income. There's no reason to deny that. If you're using BIG to help pay your monthly bills, that reduction will obviously affect your cash flow. But if reducing the distribution allows the fund to retain more resources, build a more sustainable portfolio, and reduce pressure on NAV, then it may be a reasonable trade-off. In investing, sometimes you have to sacrifice a little today to protect much more tomorrow. Think about a tree. Someone who only cares about how many fruits the tree produces this year might want to harvest as much as possible. But an experienced gardener understands that sometimes you have to prune the branches. You have to reduce the stress on the tree. You have to take care of the roots. And there may be seasons when the tree produces less fruit than it did before. That doesn't necessarily mean the tree is dying. Sometimes it means the tree is being prepared to become stronger in the seasons ahead. I think BIG is going through something similar right now. The portfolio has changed. The distribution has been adjusted. The covered call strategy has more flexibility. And most importantly, the fund is no longer as heavily dependent on a handful of highly volatile names as it was before. Of course, we still need to watch what happens next. There are a few things I'll be paying especially close attention to over the next several years. Does the NAV remain stable? Does total return improve? Is the distribution actually sustainable? Does the new portfolio perform well across different market environments? And will Evolve continue adjusting the strategy as market conditions change? Those are the questions that really matter. Because one good month can't prove that a strategy is good. Even one good year may not be enough. But if after 3, 5, or even 10 years, a fund can continue generating high income while protecting most of its capital and producing a reasonable total return, then we'll have real evidence. And personally, I think that's exactly what makes BIGY worth watching. I don't think we should call BIGY a perfect investment. No investment is perfect, and I certainly don't think a high yield should cause anyone to ignore the risks. But I also don't think a distribution cut automatically means BIG has failed. If anything, it could be a sign that Evolve is trying to adjust the product to better fit the realities of the market. And that's something I actually respect. A good management team isn't a team that never makes mistakes. A good management team is one that can recognize what isn't working and has the courage to change. BIG has changed, from roughly 10 stocks to 23, from a relatively concentrated portfolio to a more diversified one, from heavy dependence on highly volatile stocks to a more balanced structure across technology, financials, consumer companies, healthcare, and energy. And if the covered call strategy is managed effectively, we may be looking at a very different BIG from the product investors bought not long ago. I would call it BIG 2.0. But remember, now, BIG 2.0 still has to prove itself. Not with words, not with one good month of performance, but with results over many years. That's how the market ultimately answers every question. And if you own BIGE, I think this is the time to ask yourself one very simple question. Did you buy BIGE because of yesterday's distribution? Or do you own it because of tomorrow's strategy? Those are two completely different questions. If you bought BIG simply because it used to pay 31.25 cents per distribution, then the distribution cut may force you to reconsider your entire investment thesis. But if you bought BIGE because you wanted exposure to a more diversified portfolio of U.S. stocks combined with a covered call strategy designed to generate income, then the changes happening now may be worth watching closely. And that's also why I don't think a long-term investor should react too quickly to an announcement like this. Don't sell because of emotion. Don't buy simply because of the yield. Look at total return. Look at NAV. Look at the portfolio behind the ETF. And look at the management team's ability to adapt. Because ultimately, investing isn't a competition to see who receives the most money this month. It's a long-term game of turning your capital into a sustainable asset that can continue working for you for years. And that's why, if I were evaluating BIG today, I wouldn't just look at the BIG of the past. I would look at what BIG is becoming. A broader portfolio, an adjusted income strategy, a lower distribution that may be more sustainable, and an opportunity to balance income today with growth tomorrow. Will BIG actually succeed? We don't know yet. But I think the story is worth watching because sometimes a turning point in an investment doesn't begin with good news. It begins with an uncomfortable decision, a decision that disappoints investors. But if that decision helps protect the foundation of the investment, then a few years from now, we may look back and realize that what appeared to be a step backward was actually the first step towards something better. And that's exactly what I'll continue watching with BIG. Not just how much money the fund pays us, but after it pays that money, how much of the underlying asset we still have left. Because income can help you live today, but a sustainable asset is what can help you live well in the future. If you own BIGE, I'd really like to hear what you think. Are you going to keep holding? Are you considering buying more? Or has the distribution cut changed your investment thesis? Leave a comment below and share your reasoning. You don't have to agree with me. I want to hear the opposing viewpoints too, as long as we're analyzing them based on data and sound reasoning. And if you found this video helpful, hit like and subscribe so we can continue exploring the important stories behind the market together, rather than simply chasing the attractive numbers we see on the surface. Remember, don't just ask how much an investment pays you. Ask, how much wealth can this investment help you build over the next 5, 10, or 20 years? That is the question a long-term investor should be asking. And that's how I look at BIG today. Not the BIG of yesterday, but the BIG of tomorrow.